How do owners of large property portfolios use captives?
To start, it's for coverage gaps, especially the coastal property owners, California, Florida. You end up with big, sizable deductibles, if you can get coverage at all, but sizable deductibles for earthquake, California, hurricane, wind-driven rain, on the East Coast. And so what the captive does, obviously, gives you an ability to write policies for those deductibles and provide coverage that the traditional market is not. The other piece of it is, and it's related, but is risk distribution. So many property portfolio managers, owner operators, they have a bunch of different projects, a bunch of different entities that own the various properties. And within those different entities, they could have different stakeholders. One of our clients, they have, 200 different, investors in 20 different properties. And what the captive has given them the ability to do is, in exchange for a small little amount of premium each year from each property partnership, it's given them the ability to provide, again, that earthquake, hurricane, wind-driven rain coverage from the captive to each of these disparate property partnerships. And when those catastrophes have come down the road, more with the hurricanes, less with the earthquakes, but when those catastrophes have come down the road, the captive is providing coverage for really, really big losses, losses that would, for that individual partnership, perhaps set their distribution schedule or income payments back by 24 months. If you have to rebuild a building after a hurricane and it's excluded from your traditional coverage, and you have to get loans or rebuild, then that's going to impact the amounts that you're paying out to your investors. But the captive providing that coverage, paying for the new roof, paying for the rebuild of the building, allows them to continue to perform for their investors. And that's where it's the risk is distributed amongst the entire portfolio, but it's able to respond to the specific insureds that get hit. And that's really been a big, pretty cool thing that we've seen happen over, a couple different cycles now of hurricanes that have come through. Certainly as you grow and get on down the road, we have some property captives that have gotten very large. They started out insuring deductibles, at a small level, and they've grown to the size now where they're discussing, do we go out and get an AM Best rating, the credit rating, like we were talking about earlier, so we can issue direct policies on our own. That's something that happens after maturing over a period of years, but they're growing towards that. We have another client that is looking at taking some substantial retentions across the board, not just earthquake and hurricane risk, but all the losses. And then, going out and buying reinsurance from, be it the London market or some other carriers, that operate in the property space as reinsurers, which is, again, just insurance for insurance companies. So, early on, it's a real good, risk control, risk minimization, funding mechanism. Over time, there's some more creative and adventurous things you can do, looking at AM Best ratings or potential, for saving money via reinsurance.
Yeah, I'm always surprised, and I guess I shouldn't be, that, here you are in California, and a lot of people just simply choose, even with multi-nine-figure portfolios, choose not to buy earthquake cover, right? They just decide that we're going to go naked on that type of risk for insurance. And to me, the best structure is formalizing the shifting of that risk to the captive, because essentially what they're banking on is they're going to say, if something bad does happen, we're just going to fund it out of cash flow or fund it out of our credit lines. But in buying insurance from your insurance company, you're certainly getting the tax benefit of that premium deduction. You're now shifting annually money into this insurance company that is specifically set aside for that loss. And frankly, it's under a regulated insurance body. And so from a creditor protection perspective, certainly out here in California, people with that type of net worth are always concerned about that. So to have assets held outside of someone sniffing around to sue you is always a positive thing, in my opinion.
And another thing is, if a client with a large commercial property portfolio, let's say that their deductible is $100,000, well, that's going to creep up over time just because of natural the insurance companies increasing deductibles. But it's at some point, what we see, like we have clients in Texas with real estate portfolios, at some point the market gets hard and those people leave. Jared mentioned coastal properties in Florida. You know, you could have a great company for years and years and years. You're funding your captive, you're taking your, you know, your SIRs or deductibles, and then all of a sudden your client pulls out of the marketplace. And because of that, because you created the captive and you have all of this reserves, it gives you a lot more flexibility on when you go back out to the marketplace, because now you have capital in your own insurance company. So you're calling the shots. You're not relying on them. Whatever carrier is giving you the quote, they know that, you know, you're over a barrel and you have to buy their insurance. It's like we were talking about with the cannabis industry, with commercial property. If you have this, it's now a negotiating point. If it's too expensive, you say, fine, we're just going to go and buy reinsurance. But it's not something where you can just jump into it. It's because you set the groundwork year after year that it gives you the flexibility to do that when those hard markets come, which we haven't had a really hard market for years, but it's here now.